Hey guys, here's your weekly market update. The Federal Reserve just cut interest rates by 0.25%, which is the third cut this year after similar moves in September and October. This is a slow, gradual easing trend, not a big emergency slash of rates. But here is where it gets interesting, right? The vote inside the Fed was split. One member wanted a bigger 0.5% cut, and two members didn't want any cut at all. That's the biggest disagreement we've seen in the Fed in years. So, what does this mean for you in mortgages? Well, first off, mortgage rates do not move in a straight line with the Fed's fund rate. They follow what investors expect for inflation and broader economic data, not just what the Fed does at one meeting. Because this cut was widely expected, a lot of it was already priced into the bond markets. That means mortgage rates may not drop overnight just because the Fed moved their rate by 0.25 point. In fact, on some recent cuts, mortgage rates have stayed flat or even ticked up just a bit as the markets react to the Fed's comments, not just their headline. And that's what we saw happen in the October rate cut. Second, the outlook the Fed gave for 2026 matters, right? Right now, they are only projecting one small cut next year, and some members are still arguing for no cuts or even a possible rate hike. That tells you the Fed is not convinced that inflation is fully tamed. So, what's this mean? This means you'll likely see windows of opportunity where rates dip and then bounce rather than one smooth decline. Having that in mind, if you want to stay current, keep watching my market updates, subscribe to my market newsletter, and we will see you next week.